An initial public offering, when a successful private company decides to offer shares to the public, is an exciting time for the company, its original shareholders, and the investing public. All of the excitement and publicity around an IPO often lead investors to want to get in on the action. If you can get in on the ground floor of an IPO, that is, get an allocation in the initial share offering before the stock starts trading, there is evidence that you are likely to make a profit. IPOs tend to be underpriced. While this might seem like an obvious way to easy profits, there are a few crucially important things for you to consider. I'm Ben Felix, Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why IPOs don't live up to the hype. It is well documented that IPOs tend to be underpriced. In other words, when the underwriter determines the price that the company should offer its shares to the public, the data show that they tend to set a price below where the market will price the shares. This creates the perception of a real opportunity for investors to make a quick profit on the first day of an IPO. The media often enjoy reporting on the large first-day profits that IPO investors make. The challenge for most investors, though, is that getting in on the initial allocation is really hard. The majority of the initial allocation generally goes to institutional investors, which we'll touch on again in a minute, while the allotment for retail investors is likely to be allocated to larger brokerage clients. Fidelity describes the allocation process for retail investors as follows. Each customer who wants to participate in an IPO offering is evaluated and ranked based on his or her assets and the revenue they generate for the brokerage firm. Typically, customers with significant long-term relationships with their brokerage firm will receive higher priority than those with smaller or new relationships. This statement from Fidelity is supported by a 2018 paper in the Journal of Finance titled Quid Pro Quo: What Factors Influence IPO Allocations to Investors, where the authors examined 220 IPOs from January 2010 through May 2015 to test the determinants of IPO allocations. They found strong support for the brokerage revenues associated with a client being a significant determinant of investors' IPO allocations and profits. Based on this, if you are able to get in on an initial allocation, unless you're a high-value brokerage client or an institution, you're likely getting in on an IPO with a poor expected outcome. There is adverse selection in IPO allotments, where those with expected weak first-day returns have been easier to get access to ahead of time. I think it's safe to say that, in general, smaller retail investors and DIY investors who are not generating significant revenues for their brokerage firm will be hard-pressed to get in on the initial allocation when a hot company goes public. Interestingly, there is evidence that new mutual funds use their institutional status and relationships to get in on initial IPO allocations in an effort to boost their returns. This was detailed in a 2017 paper, IPO Allocations and New Mutual Funds, by Frankie Chow, Yi Gu, and Christodoulos Luca. They looked at data from 1998 to 2015 and found that new mutual funds tend to outperform during the first 6 months after inception. This outperformance was concentrated in new funds that held underpriced IPO stocks. After the first 6 months, performance fell substantially. The suggestion in the paper is that a fund company might choose to allocate all of their IPO allotment to a new fund in an effort to boost its performance to attract new investors. While this works to get an initial boost, the fund performance tends to drop off quickly. The reason that this information is relevant to our discussion is that it shows the level of competition for initial IPO allotments. I wouldn't take this as a signal that all new mutual funds will perform well. Keep in mind, it is easy to identify the funds receiving preferential IPO allocations after the fact, but I wouldn't start speculating on new mutual funds in an effort to profit from this phenomenon. Alright, so you're probably not going to get in on the initial allocation when a company goes public, but that doesn't mean that you can't buy shares on the first day of trading. Once the shares are listed on a stock exchange, many of the people holding the shares will want to realize the profit from the likely underpriced IPO, and you could be the one to buy them. The performance of IPOs after the first day of trading has also been studied extensively. In the March 2017 paper, The Long-Term Performance of IPOs, Revisited, Daniel Hochul, Larissa Karthaus, and Marcus Schmidt detailed the performance of US IPOs between 1975 and 2014. They looked at a total of 7,487 IPOs over time periods ranging from 1 to 40 quarters after the first trading day. They found that IPO firms tended to behave like high beta stocks with negative loading to the value factor, and that they underperform for the first 2 years even when common risk factors like size, relative price, and momentum are accounted for. This underperformance gradually declines with longer time periods, becoming statistically insignificant after 2 years. In summary of their paper, IPO firms have unfavorable exposure to risk factors, with high betas and negative loading to value, but even when those are accounted for, IPO firms tend to underperform for the first 2 years. These findings are also supported by more recent research. In a 2019 paper from Dimensional Fund Advisors, the authors examined 6,362 US IPOs between January 1991 and December 2018. To evaluate IPO performance as a whole, they constructed a hypothetical market cap-weighted portfolio of IPOs issued over the preceding 12-month period and rebalanced monthly. They excluded first-day returns from the analysis. They found that over the full sample period, the IPO portfolio delivered a return of 6.93% with a standard deviation of 27.62%, while the Russell 3000 index, a US total market index, delivered a 9.13% return with a 14.28% standard deviation. They also split the full sample period into 2 sub-periods, with one ending in the year 2000 to isolate the high volume of IPOs over that time period. The result for both sub-periods, before and after the year 2000, exhibited underperformance relative to the market with substantially more risk as measured by the standard deviation of returns. This result corroborates the findings of Hochul, Carthaus, and Schmidt, who found that IPOs performed poorly over the first 2 years. The Dimensional paper also applied the Fama-French 5-factor model to the IPO portfolio's returns, and found that the returns are well explained by the factors in the model: market beta, company size, relative price, profitability, and investment. This suggests that IPO firms, as a group, have behaved like small-cap growth stocks with weak profitability that invest aggressively. These types of stocks, whether they are recent IPOs or not, tend to underperform the market. What we can conclude from the research that we have discussed in this video is that if you want to make money from IPOs, you have to get in on the initial allocation. But doing so, especially for hot IPOs, is really unlikely, unless you are considered a highly valued client by your brokerage. If you are able to get in on the initial allocation, there's a good chance that it's not an IPO that will have a big first-day pop. The better the expected pop, the more likely the IPO shares will be allotted to institutions and the largest retail clients. If you miss out on the initial allocation and instead buy the shares on the secondary market once they've started trading, you're buying into shares that will likely perform like a small growth, low profitability, high investment firm, which have an unattractive risk-return profile. Even beyond that, let's keep in mind that any time that you buy one stock, you probably aren't going to get the returns of the asset class that it belongs to. On average, a secondary market IPO investment will give you the poor expected outcome of small growth, low profitability, high investment stocks. But unless you are building a diversified portfolio of recent IPO stocks, your actual outcome on an individual stock investment will be driven by the specific risk of the company, which delivers a random outcome. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone who you think could benefit from the information. And don't forget, if you've run out of Common Sense Investing videos to watch, you can tune in to weekly episodes of the Rational Reminder podcast wherever you get your podcasts.